The different currency and risk profiles of the Harmony funds produced a wide range of returns during May, from small declines through to decent gains. Starting with the declines, the Asian portfolios retraced some of the progress they made in April, falling 0.6 to 0.7%, reflecting weakness in emerging market equities. However, both remained up by around 5% year to date. The US dollar portfolios posted very small gains, while the sterling portfolios made more meaningful progress, with returns of 0.9 and 1.3% for the balance and growth profiles respectively. The Australian Dollar Growth Fund also gained 1.3%. Once again, it was the European Diversified Fund that posted the best return, gaining 2.6%. This range of returns delivered across the different funds is far wider when measured over 12 months. Over this horizon, the Asian and US dollar portfolios have posted low to mid-single digit returns, having suffered from the headwind of a very strong US dollar reporting currency, while the sterling portfolios have delivered high single digit returns. But it is the Australian dollar growth and European diversified portfolios that have led the way, with gains of 13.3 and 16.9% in their base currencies. These returns are net of all fees. Overall, I'm pleased to note that the returns are ahead of most peers with comparable currency and risk profiles, whilst also comparing favourably with a combination of equity and bond index returns for each region. Within developed markets, equities outperformed bonds in May. The MSCI World Index was up by 0.3% in the month, held back by a recovery in the US dollar after it was weak in April. Japan outperformed with a return of around 5% in local currency terms, while the UK, Europe and US markets returned around 1%. Both Europe and Japan have now risen by around 20% so far this year in local currency terms, compared to the US, which is up by only 3%. In contrast, during May, emerging market equities fell 4%, led by big falls in Brazil and Russia, as commodity prices came under renewed pressure, while the oil price also fell. Government bonds mostly posted losses during May. US Treasuries were down around 0.2%, while European government bond indices fell 1.5%. Considering one of the drivers of the decline in European bond indices, the yield on 10-year German bonds rose from 0.36 to 0.49% in the month, which is particularly worthy of note given, although it's a small yield change, the change in direction and the adverse capital movement it translates into for holders of such bonds. In contrast, corporate bonds continue to outperform, with modest positive returns in the month. In aggregate, both asset allocation and manager selection made meaningful contributions to performance of the Harmony funds during May. Our continued preference for equities over bonds and cash was a key driver of positive returns, and also helped to protect capital. Asia was the exception, given equity struggled there, but this was partly offset by outperformance from our selected managers in this region. Our UK and European equity managers performed very well, of particular benefit for the sterling and European funds. For example, both of our European equity managers outperformed the market by over 4% in May. Meanwhile, our holding in the Polar Japan Equity Fund, represented across all the portfolios, gained almost 8%. Meanwhile, listed real estate underperformed in sympathy with rising bond yields, but the manager we appointed earlier this year outperformed by almost 2%. This lends support to our original investment thesis that the Third Avenue strategy can provide exposure to the asset class, but with less sensitivity to the downside risks that may present themselves during periods of rising bond yields. The Harmony funds maintain limited exposure to government bonds. Instead, the fixed income assets that we hold in the portfolio, principally high yield, convertible, and emerging market bonds, performed well in May, with positive returns in most cases. We made two small changes to the funds around the end of April, early May. In the Asian portfolios, we switched our emerging market equity allocation from our previous incumbent manager, Dimensional, to a new fund managed by Sands. We continue to hold Dimensional in the other Harmony funds, but made this switch within the Asian funds in recognition that, firstly, around 2/3 of the Sands fund is invested in Asia, and secondly, their growth investment style is very complementary to the more value-oriented exposure that our other Asia-focused equity managers provide. Sands is a manager we've known for a long time, Founded in 1992, they are an independent, Washington-based investment management firm with a focused strategy lineup and a highly experienced and stable team. They run a roughly 40 stock portfolio that invests in a small subset of market-leading, emerging market businesses that they believe are truly able to sustain high levels of future growth. They've implemented this approach consistently for over 20 years, and we rate them as one of the best aggressive growth managers globally. We also added a small holding in a new global convertible bond strategy, managed by Westwood, across all the portfolios. This follows on from a detailed research review we've conducted into the sector, reviewing and meeting more than 10 managers. Westwood was founded in 1983 and now manage over $20 billion across various US and global strategies. The convertible bond team joined just last year from Aviva, where they'd worked together for over 13 years managing similar strategies. The fund we have invested in focuses on balanced convertible bonds that display the ability to participate in some equity upside, whilst limiting the downside due to their bond-like characteristics. Due to relatively small assets in the strategy, the portfolio managers are able to be more selective than many of their peers, holding around 40 to 60 names, with a tilt towards small caps and growth names within the convertible universe. This new strategy sits alongside our existing holdings in two convertible bond strategies managed by RWC, which, for the time being, continue to represent the bulk of our exposure to the asset class. The inclusion of both the Sands and Westwood funds represent positive changes that are the product of our team's detailed and wide-reaching research process. We believe both additions improve the performance potential of the funds, whilst also improving style balance and diversification.